If you're confused about the markets and what's happening next, don't fret. In yesterday's video, I pointed out that several economists think that the Fed should cut rates right now to reduce inflation. However, former Treasury Secretary Larry Summers says there's a serious possibility that the Fed's next rate move is a hike. This was published yesterday just after Deutsche Bank was calling for a rate cut. So let's see what Larry Summers has got to say in this article. So here I quote, "You have to take seriously the possibility that the next rate move will be upwards rather than downwards." Lawrence Summers, economist and former US Treasury Secretary. Summers' remarks in an interview Wednesday with Bloomberg Television came after the March Consumer Price Index showed a hotter than expected inflation reading for both the headline figure and the core rate, which strips out volatile food and energy prices. And there's a little quote in the center here from Larry Summers saying, "I see no case for a cut in June, but facts can change." Former US Treasury Secretary Lawrence H. Summers. Bit of a tongue twister, that one. Fed funds futures subsequently showed that traders were slashing their bets on a quarter-point rate cut arriving in June. That seems to have been a bet that some traders have actually lost. And there's an article in Bloomberg about a $50 million loss on a position, based on the idea that the CPI data would show an improvement in inflation, which it actually didn't, of course, as we know. The market now reflects an 85% probability that the central bank leaves rates on hold at its June meeting, up from a 42.6% chance on Tuesday. Summers said that while circumstances can change between now and June, the current facts would make a June cut seem a dangerous and egregious error compared with the errors the Fed was making in the summer of 2021, when policymakers left rate hikes on hold amid expectations that rising inflationary pressures would prove transitory. As a result, stocks and treasuries sold off sharply in the wake of Wednesday's data. The yield on the 2-year Treasury note surged more than 22 basis points to trade near 4.97, while the 10-year Treasury yield surged nearly 19 basis points to top 4.55. The Dow Jones was slumping 529 points, or 1.4% on Wednesday afternoon, with the S&P tumbling 1.2% and the Nasdaq 1.1%. So let me know in the comments what you think. Should they keep rates higher for longer and do nothing, or should they act more quickly? One thing's for sure, the Fed's in a really tight spot. We've got sticky inflation, doesn't seem to be going down, rather it seems to be going up. And yet at the same time, we've got incredibly high interest rates. And there's no real reason to bring them down right now, with the economy seemingly quite happily ticking along, even thriving. But we have a debt problem. Not only for individuals who want to purchase cars and houses, but for companies who want to purchase properties to lease them out. And probably more pressingly, the US federal debt, which is now over 6% of GDP. As I said in yesterday's video, to top all of that, we've got elections coming up and central banks all around the world deliberating about their own rates, which will affect the carry trades and the currency markets, and as a result, all sorts of other things too. We've got the PPI, Producer Price Index, coming up today, and that's going to be closely watched, I think, after the CPI yesterday. Have a great trading day. I'll speak to you soon.